Hey everyone, welcome back to another J-Pow meeting. We got J-Pow ready to do some chit-chat. We're gonna get Jay doing the good old inflation. Is gonna be on a bumpy path, and things are a little poopsie-doopsie with getting inflation straight down, and we're waiting for more data. Nobody knows data like the Fed, and they don't even know data. So anyway, yeah. So we've got this meeting beginning here in just about a minute is what the schedule is. You've presently got a bunch of sort of volatile, somewhat of an uptrend is what we've been trying to form since since about 7:30 California time. The last 3 hours have been slow little uptrend here. It's not been very violent to the up, so it's sort of almost as if you're just waiting for like some kind of catalyst to push this market in either direction. That could be up, that could be down, it could be Israel, it could be Donald Trump's stock tanking even more. It's down to 14% now. It was down at 10% a little earlier and was sort of stable there for a moment, and now it's sort of a oopsie-doopsie to down again. So on standby now for the event to begin. The S&P is about to turn red. It looks like S&P is now flat at 0. Amazon's up about 11 bips. You've got Nvidia up almost 2%. So AI wants to participate in el party. You've got S&P now down about 3 bips. Nvidia pretty stable. BTC had a nice little run up again. BTC ran up to 62.8. It's been sitting around 61.9, 62.2 for a bit there. And then, of course, remember live this morning, we were looking at 63 being a kind of a catalyst point there on a downtrend that BTC has been on. So we'll see if we end up getting rejected at that 63 or if we end up breaking through. We'll watch that. Yeah, Tesla did also, you're right, bounce on a longer-term downtrend. Pretty close. 152 is about that level. It did bounce at about 153.75. So you did have that support, sort of get pre-bought a smidgen there, which is not horribly abnormal. Waiting now for this to begin. And then we'll have good old J-Pow. So events scheduled for now. They're obviously not live yet, but that's okay. They are on standby. So I expect any moment we will have the actual J-Pow portion. It does look like we can get an intro version to the event because, well, the event's been going for a while, but we don't have J-Pow on it yet. Let me see here. There is another version. We can watch the actual event. They're doing sort of introductions right now, and we could see that here.
Of our two countries.
Oh, hold on. I still have the Fed one going in the background with the music. The Fed one's not wanting to play until J-Pow's out. And he's not out yet as they're doing it what appear to be introductions. But we can listen to it here.
Recognizing his significant achievements across politics and policy and business and philanthropy, he's the former finance minister of Canada, playing a key role in shaping sustainable economic policies of the Trudeau administration, including Canada's economic response to COVID-19.
That's not J-Pow.
And a key reason for Canada's aforementioned above-weight punching into international diplomacy. As a business leader, he grew the multinational human resources firm Morneau Chapnell.
Yeah, we don't really care. So we're really just waiting for J-Pow right now. He'll be up here. He's supposed to be up as of 3 minutes ago. Fed's not even interested in showcasing this right now because we're just waiting for him. We'll see if we get any kind of heart palpitations in the market going into or during the actual event. I'm noticing a little bit of topping out on Affirm, though it did have a good recovery from the morning. Tesla is also having trouble getting above that 158 level. I'm watching DJT continue to fall down. I'm watching Nvidia. Are they actually going to be able to get above 880 today? Not a terribly uncommon place for it to be. The Qs, boy, it's been a very soft uptrend. I wonder if we're going to end up getting back to any kind of lower trend there. But soft uptrend today. I'll show that here on screen in just a second. There we go. This is sort of what I'm watching on the Qs. I'm kind of calling it the day shelf. So the day shelf shouldn't have us get under the 430s at all today anymore. Oh, there's Jay. He's in the middle. Okay, let's listen in here.
The most important division of the bank's economic staff in the early 2000s, having played a critical role in Canada's response to the great financial crisis in his post in the Canadian finance.
Yeah. More introductions. Boring. Jay Powell's got to be bored by this stuff. I don't know. Maybe he gets excited by it. We're at 63 on BTC right now. That, for me, is a downtrend. I'm watching this. You can see my yellow line here. We're hitting it right here. And so I'm watching that closely as we can confirm whether or not we're going to get a breakthrough or if we're going to get resisted there. So we'll see. Keep listening here.
Doctoral thesis on Metternich received very high marks. So just let me say this. There is an anteroom off the main boardroom in the Eccles building, which is the Fed's true headquarters building. They're currently slumming it in an annex, where the portraits of all the Fed's chairmen hang. And as you look around them, it is borne in on you that none of them will have been as consequential across as broad a range of matters as Jerome Powell in managing the remarkably low inflation and high employment of the pre-COVID period, in the world historical response to both nationally and globally to the COVID event, in the first major review and explanation of a formal monetary policy framework for the Fed, and in managing the quite effective response to the most significant inflation in almost half a century, but one in which many of the traditional guideposts could not be helpful, requiring very creative thinking and deft management of the extremely well-meaning but hydra-headed body that is the Federal Open Market Committee. So with that, let me thank you again for coming, and let's turn to our panel.
Okay. They need some music. Like dun dun dun, like Who Wants to Be a Millionaire intro.
Well, I want to start by thanking you, Randy, for that very, very generous set of introductions, and also for your willingness to step forward as the co-chair of the Washington Forum on the Canadian Economy. So we very much appreciate your esteemed leadership, and one of the key reasons we're here today is due to that. So really appreciate it. I'll just say personally, one of the things I like most is you said Canadians were sane. So that's a pretty good starting point, okay, I think, for our discussion here today. So with two esteemed panelists, I won't really be speaking much. I want to give both of you gentlemen an opportunity to talk a little bit about your respective economies, and I guess also recognize that we're here to talk about the Canada-U.S. relationship and what is both distinct and different about our economies, but also what we share. So maybe with that, I could start with you, Governor Macklem, and then we'll talk to Chair Powell.
Well, thanks, Bill, and I think you better call me Tiff. It is a pleasure to be here, and thank you and Randy for launching this, for inviting us both. I am very pleased to be here to say a few words about the Canadian experience, and I always enjoy comparing notes with Chairman Powell. Now, as Canadians, we invariably compare ourselves to Americans, and maybe it's human nature, but we tend to focus on the differences. We've got different systems of government. We're bilingual in Canada. We have 3-down football, and we even have very colorful polymer banknotes. And certainly our climates, I think, are certainly the IMF meetings are always a welcome first blast of spring for the Canadians. Our economies obviously have much in common, but again, we often focus on the differences. If you look at growth in Canada and the United States over the 20 years leading up to COVID, remarkably, the average was exactly the same, average 2.2% in both countries. The sources of growth, though, have been a bit different. In Canada, we've grown more by adding workers. Our participation rate has risen more, and we've had proportionally higher rates of immigration. In the United States, adding workers has also been important, but increasing output per worker or productivity has made a relatively larger contribution. And I will admit in Canada, we look at U.S. productivity growth with some envy. And we do ask ourselves, what can we learn from the U.S. experience? We are concerned about productivity growth in our country. Turning to the financial system, we both have strong banking systems, but the structure of our banking systems is quite different. In the United States, you've got a lot more banks than we do in Canada. In Canada, we have 5 large national banks and a number of important regional players. The structure of our mortgage market is also somewhat different. In Canada, the typical mortgage is 5 years. In the U.S., typical mortgage has a term of 30 years. And our banks in Canada tend to hold mortgages on their balance sheets. U.S. banks securitize a lot of their mortgages. Despite these differences, our systems are very integrated, and indeed, a number of large Canadian banks have large operations here in the United States. Our pandemic responses were also mixes of similarities and differences. You know, broadly speaking, the paths of our two economies were pretty similar. We both cut interest rates very dramatically to effectively zero to support the economy through the pandemic. Then we both raised them very forcefully as inflation rose rapidly, and we've both seen inflation come a long way back. Growth has been more resilient in the United States, though, through this tightening cycle, and I think that's partly related to the stronger productivity growth I mentioned in the United States. And it may also be related to the fact that monetary policy may be having a bigger impact on households in Canada because of the different structure of our mortgage market. More of our mortgages have reset in Canada, so more people are feeling those higher interest rates. And that has restrained household spending more in Canada. You know, in each of our countries, I do want to underline that, you know, we gear our policy decisions to our domestic monetary policy mandates. And in Canada, we have our own currency, we have a flexible exchange rate, so we can run our own monetary policy. So simply put, you know, we don't have to do what the Fed does. We can do what Canada needs. I do think, though, we're looking at the same things and asking ourselves the same questions. I think we both need to feel confident that we're clearly back on a path to 2% before it would be appropriate to reduce interest rates. Last week in Canada, we held our policy rate at 5%, where it's been since last summer. We did stress that we are encouraged by the recent progress we've seen on inflation, and we want to see it sustained. And just this morning, Statistics Canada published the March CPI. As expected, headline inflation came in close to 3%. We have seen gas prices in both our countries move up. Importantly, though, measures of core inflation did tick down again, and that does suggest that underlying inflationary pressures are continuing to ease. So we continue to be moving in the right direction. The other thing I want to underline is that in the conduct of monetary policy, we do spend a lot of time looking and understanding what is going on in the United States. The U.S. economy has a very big impact on the Canadian economy. We also watch the U.S. economy closely, particularly through the extraordinary period we've all been through in the last few years, because the more we understand what we have in common and our differences, the better we can learn from each other's experience. And let me just close on a few words on just how integrated the Canadian...
Yes, then get to Jay Powell.
And you highlighted.
I feel like even people in Canada care more about what Jay Powell is going to say than what this guy's saying. Sorry.
Your perspective. I think the economic relationship really is the model for mutually beneficial open trade and investment. 77% of Canadian exports flow to the United States. And as you underlined, what less people know is that Canada is the United States' biggest export market. 17%, or as you said, almost 20% of U.S. goods head north to Canada. If you look at foreign direct investment, there is a similar two-way dynamic. In 2022, more than half of Canadian FDI went to the United States by far the largest share of our FDI. That was roughly $43 billion.
That's foreign direct investment.
Same year, $50 billion of U.S. FDI came to Canada. So it's a pretty balanced relationship. And I think what these numbers underline is just how close that economic relationship is and how it works in both directions. And the final thing I'll say is when you look forward, we face many of the same structural challenges. Our labor forces are aging. There's going to be a big challenge with new technology, training, and making sure we have the skilled workers our economies needs. Climate change is affecting both our economies. We're both grappling with shifting trade and investment patterns globally. Supply chains across both our countries need to build more resilience. Conflicts internationally are increasing global uncertainty. And for all these reasons, I am very glad we're having this discussion. We do have much in common. And Randy, as you underlined, when we work together, we can get a lot more done. Thank you.
All right, here we go. Jay Powell.
That's a great place to start. Chairman Powell, really interested in hearing your perspective.
Another
Yeah, we
place
are.
to start is to say, why don't you call me Jay and call Tiff?
Okay, I know I do it behind the scenes. I'll do it in front of the scenes, too.
Great. So let me start by thanking Randy and Bill and Xavi and Tiff for this. It's great to be here today. I want to echo what Randy said about the mutually beneficial, respectful, great relationship we have with Canada, economically, culturally. And I'd also like to echo, I thought Tiff did a great job talking about the similarities and differences in our economy, our financial markets, the challenges we face in our policy stance. It's almost as though you somehow had a copy of that part of my remarks, Tiff. So I'm not going to repeat that, but what I will do is talk, if I could, a little bit about the U.S. economy and where we find ourselves right now. So as I think Randy pointed out, the performance of
Here we go. Puts or calls.
over the past year has really been quite strong. We had growth of more than 3% last year as rebounding supply supported both robust growth and in spending and also employment, alongside a considerable decline in inflation. The more recent data show solid growth and continued strength in the labor market, but also a lack of further progress so far this year on returning to our 2% inflation goal. So I'll say a little bit about our two mandate goals, maximum employment and price stability. As I mentioned, the labor market remains very strong. Payroll job gains have been strong over the first quarter, averaging just a tick above 275,000 per month. The unemployment rate has been below 4% for 26 consecutive months, which hasn't happened in more than a half a century, the longest streak of its kind.
BTC down $400. SPY just dropped 20 points.
By a substantial increase in the workforce due both to rising labor force participation and a substantial increase in immigration, as indeed Canada has experienced as well. So even with this strength, by many measures, our labor market has been moving into better balance over the past year. The ratio of job openings to unemployed workers was extremely elevated in 2021 and 22, has now moved back down to levels just above the pre-pandemic era. Surveys of workers and businesses indicate a normalizing labor market. So do the rates of both quits and hires. And broader wage pressures also continue to moderate, albeit gradually. So the overall picture for the labor market is one of real strength, but gradual normalization. Turning to price stability, our inflation mandate. Inflation, of course, declined quite significantly over the second half of last year, over the whole year, but particularly in the second half. But 12-month core PCE inflation, which is one of the most important things we look at, is estimated to have been little changed in March over February at 2.8%, and the 3- and 6-month measures of inflation are actually above that level. So we've said at the FOMC that we'll need greater confidence that inflation is moving sustainably toward 2% before it would be appropriate to ease policy. You know, we took that cautious approach and sought that greater confidence so as not to overreact to the string of low inflation readings that we had in the second half of last year. The recent data have clearly not given us greater confidence and instead indicate that it's likely to take longer than expected to achieve that confidence. That said, we think policy is well positioned to handle the risks that we face. If higher inflation does persist, we can maintain the current level of restriction for as long as needed. At the same time, we have significant space to ease should the labor market unexpectedly weaken.
That's bad.
Right now, given the strength of the labor market and progress on inflation so far, it's appropriate to allow restrictive policy further time to work and let the data and the evolving outlook guide us. Come what may, we remain strongly committed to returning inflation over time sustainably to 2%.
That kills June for sure.
Well, thank you. I think that's a really important frame for our discussion today. One of the things that I remarked on when I first got into public life was how often I saw my international peers as we moved around.
I'm just going to quickly say, it doesn't sound like he's implying that we need to raise rates, but he's definitely very clearly here saying it's going to take longer before we cut, y'all. Because we can cut quickly if we need to, but there's no sign we need to right now. Let's keep listening because there'll be some questions that come out of this.
Work together or don't work together. So, maybe I could ask you, Jay, to give a perspective on how that happens from your vantage point.
Sure. So to give you an idea, we do meet quite regularly. So Tiff and I attend 2 G7 meetings per year for ministers, that's finance ministers, and central bank governors. We don't attend the leaders meeting, but we attend, in the United States, but we attend the meetings with the finance ministers, which Bill was, and also 2 G20 meetings. So that's 4 meetings per year right there. We also have 6 meetings at the Bank for International Settlements in Basel. One of those is now virtual, but we're and that's only central bankers, no finance ministries. So it's all central banking stuff. And, it's economics, it's financial regulation, all those things. We also come here to Washington, or every 3rd year we go someplace else twice a year for the IMF World Bank meetings, which is kind of what everybody's doing in Washington right now. So it's a lot of meetings. What do we do at these meetings? Fair question. Essentially, the central bankers are having an ongoing conversation about what's going on in their own economies and their own financial markets, their own regulatory world with each other. And we're also talking about the big global issues of the day, as you would expect. So some of which are really the business of the elected government, not the business of the central bankers. But we have that discussion. It's more or less ongoing. We're seeing each other all the time. They're very informative, these discussions, and they really are, for me anyway, part of the way that I get to thinking about what the right policy is for the United States, is to hear what is going on around the world, what's happening globally, and how are people thinking about that. So it's very, very useful, particularly, though, given our close cultural, financial, and economic ties with Canada. Those discussions are especially fruitful and important, and I have regular conversations with Tiff. By the way, I do keep very close track of the actions of the Bank of Canada. I read Tiff's press conference transcripts carefully and pay close attention to that. Tiff did mention the similarities and differences. I'll say one more thing, which is we go to Basel, as I mentioned, 5 times a year. You're a long way from home, and we're there for 4 or 5 nights, and there are usually 1 or 2 nights off. So we go looking for someone to have dinner with, and very frequently we wind up with the Bank of Canada delegation who are really good and very funny and a lot of fun together. So we have a very close relationship with the bank and great respect for that institution, as I'll have a little more to say about lately.
That's cute, Powell. Now talk about rates.
About our relationship is we did do, as Randy pointed out, our first review of our monetary policy framework really ever. And we looked around. The Bank of Canada also does regularly, I think it's every 4 years. In any case, we really looked to the Canadian model and other models of how to do that. We talked to people at the Bank of Canada about how their regular framework review went. So we really benefited for that. So that's what I'll stop there.
Okay.
And Tiff, similar perspective from Canada?
Yes. I mean, I'll just add a little bit on as Jay outlined, certainly from my perspective, one of the best parts about this job is we do, the international community, the central banking community, it's not like a commercial bank where you're competing against.
I feel like this is a love story. Like these are lovers talking about we go to dinner and, we always end up at the same table.
There is a considerable openness. And, as Jay outlined, I think there's a few different functions. Yes, obviously, if you're in Canada, we have our own group at the Bank of Canada that analyzes the U.S. economy, forecasts the U.S. economy. It's very important to Canada. But, the Fed's group is a lot bigger. They got a lot more experience. Hearing what the Fed has to say is incredibly valuable for us. The other thing we do, though, is it's more than just the data and the forecasting. It's thinking through the scenarios together. What risks are on your mind, Jay? What do you think could go wrong? What are the
This is like marriage counseling. What the hell? Oh, he's bigger and more experienced, but we talk risks anyway.
Scenarios, the strategy. There are also a number of really, I would say, sort of behind the scenes very central banky technical issues that nobody really thinks about except central bankers. But what are the mechanics of QE? How do you exit from QT? How many settlement balances are we going to need to, fortunately, those are things most people don't have to worry about. They are critically important for the implementation of monetary policy. And that sort of plumbing working of the financial system, and being able to talk to people who are thinking about these things as much as you are is hugely valuable. And then the last thing I will say is, there's some things that we're only going to succeed if we do together. The obvious one would be financial supervision and regulation. Our financial systems globally are highly integrated. We were deeply reminded of this in the global financial crisis. What happens in other countries affects all of us. And money flows across borders. So, we have to do that together or it's not going to work.
Well, maybe we can drill into that for a minute. Obviously we recognize that most of your work is focused on the domestic markets.
Yes, let's drill into it. Stop it.
There's real challenge, as you mentioned, in the COVID period. The global financial crisis, that you were engaged with, Tiff, earlier in a different stage of your career. And for me, it was remarkable the number of interactions with counterparts around the world during those crises. So maybe a question to both of you is, what kind of interaction happens during periods of crisis? What doesn't happen? Are there things that we should be thinking about differently in order to prepare ourselves for those challenging moments and making sure that the financial system is resilient? So again, maybe over to you, Jay, to react to that and hear your thoughts.
Sure. So, our economies, our financial markets, all of our institutions are deeply intertwined. And when there is a situation where there's serious stress, you need to get a global perspective. You need to get perspective around the world, and you have to do that very quickly. And we, of course, can move quickly and effectively on the domestic front, but what the thing that you figure out in those times is that all the time you spent at Basel and at the G7 and G20 meetings, your colleagues, you know and trust and respect their judgment, and you don't have to go through that phase of gaining trust in people. You understand each other, you speak the same language, so there's a lot of communication. The level of communication is pretty high anyway, but during crises it goes very high. I'm constantly talking to other central bankers around the world, and also political leaders in our government, and that sort of thing. So that happens a lot. The sense of what you're doing, again, is mostly sharing information and ideas about what to do. There may be a proposal that people are looking at, and you're talking about that. So it's very useful. I say one thing to point out is it's less about coordination than it is about talking and understanding, for one reason, or at least it was during the pandemic, and that was because almost every country's interest rates were very close to zero when the pandemic hit, and so there wasn't policy space for most economies, most central banks, to do a big coordinated rate cut. We did cut very quickly to zero, but I think we were higher than almost any other nation in terms of where our policy rate was. But anyway, there's a lot of communication, and those relationships that you built up really do help at that point. In terms of you asked about learning, what have we learned? I think that the pandemic's going to teach a whole lot of lessons over time. I still think it's too early to say what they are with confidence, and I'll point out, look, the pandemic has surprised us over and over again, most recently in the United States, the remarkably strong performance of the economy at a time when virtually all economists were expecting a recession. So I think if you'd ask for the lessons of the pandemic a year and a half ago, you'd get a very different answer. Now, I think in a year or so, we'll have a lot more answers. It is a unique set of circumstances, and we're still learning, I think. But we will try to learn those lessons. Different point, I would say, about the bank stresses, another crisis, at least here in the States. I do think we can and have learned the lessons of the stress of early last spring. And I would point to a couple things that we embraced pretty forthrightly. One was that supervision was not tightly focused on the right things, was not proactive enough, was not forceful enough, and we've tried to take steps to remedy that. I also think there will be some regulatory initiatives for banks of that size and with those characteristics in time. So I do think those are lessons that we have learned.
And from a Canadian perspective, similar lessons or different ones?
Yes, I think there are similar lessons. Maybe I'll just give a couple of other examples. First though, I will just underline, when a crisis hits, you're faced with a situation, you have to make decisions, and you have very limited information. The other reality is you have a pretty narrow window to act to be really effective. And for both those reasons, being able to speak, directly to Jay, to connect with our other colleagues, finding out what's happening in their jurisdiction, how are they thinking about it, what do they see as the options, it is hugely important in a crisis. And that it's a little more, though, than just information sharing. I mean, I think it helps us avoid unintended consequences of our actions. Sometimes you do something and it works for most parties, but not one party. And in a crisis, it's the weakest link that can take you down. So you've got to be careful. It also, I think, boosts confidence in the system. If we're acting in a way that is coherent together, it boosts confidence. It looks more like a plan than a haphazard policy response. Just to give you a couple of examples, I wasn't actually governor at the start of COVID. Jay was there. But certainly looking at it from the outside, the coordinated actions of major central banks to reopen fixed income markets, providing liquidity, providing market making of last resort in scale. It reopened core functioning markets. And by all doing it essentially at the same time and all working in scale, the whole global market restarted. If that had not happened, this crisis would have been a much deeper and more severe crisis. And then the other one I'll highlight is coping with the inflation as we came out of COVID. By all being resolute in our commitment to restoring price stability, by all matching our words with forceful action, raising rates rapidly, we all helped each other. I mean, it helped reduce global inflation in goods, which was really the first part of the inflation surge, and it helped keep inflation expectations in all our countries better anchored. And I think it is a key ingredient in how we have all managed to get inflation down a long way back without causing recessions in our economies. And the last point I'll just highlight is something you said. Occasionally this coordination is very explicit. So, for example, at the time of the global financial crisis, there was a coordinated G7 interest rate cut. I remember clearly because it happened at 3 o'clock in the morning in Canada, which was a little bit of a technical challenge. But most of the time, it's not explicit coordination, but it is those conversations. It is that shared information. We have similar objectives, similar goals, similar tools, and we're sharing information, and that leads to a coordinated response.
Well, maybe you could spend a little bit more time on that from the Canada-U.S. perspective. So Randy mentioned in his opening comments the idea that when you're in Canada, you're living next to an elephant. And I think a lot of Canadians would assume that that Canadian policy has to take into account U.S. policy. So maybe could you give us a perspective into how important that is for your deliberations, and how that factors into decision making, the U.S. approach?
Well, look, I think it's pretty clear that our U.S. economic relationship is by far our most important relationship. Our economies are highly integrated. 35% of our GDP is exports, and 75% of that goes to the United States. So multiply, that's a big chunk of our GDP. Our financial markets are also very integrated. In fact, yesterday I was in New York, and when you go to New York, you are just reminded how integrated our markets are. I was at the New York Stock Exchange, and all over are cross-listed Canadian companies on many of the screens. Our financial systems are very integrated. Our banks have, most of our large banks have operations in the United States. Our pension funds are big investors in the United States. So we do spend a lot of time understanding what's going on, trying to understand what's going on in the United States and looking at the implications for Canada. There are, though, I highlighted in my opening remarks some differences. Another important difference I didn't focus on is, both our economies have big manufacturing sectors, big service sectors, large commodity sectors. But the commodity sector in the Canadian economy is quite a bit bigger than it is in the United States. Oil and gas, agriculture, forestry, mining, fishing. 40% of our exports, 13% of our GDP. And the commodity cycle can be quite different. And we have a flexible exchange rate that does help absorb the differences. And I think it's an important reason why historically sometimes our monetary policy do differ. Our cycles are often quite similar, and certainly through COVID we had a similar shock and a pretty similar cycle, and our monetary policy has been quite similar. There have been other episodes, though, where, particularly if the commodity cycle is different, you'll see monetary policy diverge somewhat from the United States. There are limits to how far it can diverge, but as I emphasized, we have our own currency, we have a flexible exchange rate, and that absorbs the differences to allow us to gear monetary policy to what we need to do in Canada.
And Jay, from your perspective, obviously the U.S. has an outsized role in the global economy, and I guess we'd be interested in understanding how much time do you deliberate on what your actions will have as reactions, and how much do you think about what's happening with global markets as you come to your conclusions?
So I'll start by saying that each central bank serves a domestic mandate, which is, in the case of Fed, is using our tools to achieve maximum employment and price stability for the benefit of the people we serve. So it's a domestic mandate. But in the case of the United States, we fully realize and appreciate that our decisions can have significant effects on not just on Canada, or Mexico, but on countries around the world. And that's all the more so because the dollar is the principal reserve currency, which strengthens the transmission of our policy through the global economy. So we also know that that those effects on global demand from our policy changes can have an effect on the United States as well. That can rebound to the United States. So we're very, very aware of all of that. And for one thing, we try to be very transparent and predictable, given the flow of data and events. I mean, you have to move quickly sometimes, but we do realize we have a special obligation to be predictable and transparent, and that benefits us in doing that as well. So international spillovers, of course, are an important consideration. We do track that. Ultimately, though, we think over time, the most important thing we can do to support the global economy is to deliver on our mandate of price stability and maximum employment here in the United States.
And is that, have there been changes in this current cycle that have driven any differences? I mean, you've talked about the different drivers for inflation this go around from previous periods of inflation. So do you think about it differently as you approach these things?
Yeah, well, specifically on inflation, I do think this is different. This is not simply the more standard case of overheated demand, which has been the typical thing in the post-war era for the U.S. economy and other major Western economies. There are similarities and differences, and I would characterize it this way, that the inflation that arose suddenly really in the early part of 2021 as economies reopened resulted both from constrained supply and also elevated and rechanneled demand from services to goods. So if you remember, and you I'm sure will, there were unexpected widespread shortages and supply chain failures on a scale not seen in recent memory. In the U.S., several million people had left the labor force, creating a severe labor shortage that was more fully felt once the economy reopened, leading to a huge spike in wages, but also in the ratio of job openings to unemployed workers. So very unusual situation. Households had elevated levels of savings, and demand was very, very strong as well. So we thought, what's different is, have thought since we've understood the situation, that restoring price stability would require both the unwinding of the pandemic-related distortions to both supply and demand, as well as the effects of tight monetary policy on demand, which would give the supply side time and space to recover. And we think today that we're seeing those two things working together to bring that end about. And you saw that, I think, in 2023, which was really, in a large way, a supply-side story. What happened was the supply side really recovered in 2023. We thought that it would recover in 2021, and in 2022, I was beginning to lose hope. And then in 2023, you saw the shortages and the issues with the trade pipelines not fully resolved, but largely resolved. You saw the U.S. labor force shortage alleviated by both higher participation among people who had dropped out of the workforce, but also from immigration. So that was the year of the supply side recovery. And you saw the core inflation rates drop by 2 full percentage points in the face of very strong growth. So that can only be explained by the enormous increase in potential output, the supply side increase over that year. So that's how I would say it's different this time.
And Tiff, maybe you can tell us how it's different in other ways in Canada. So we were talking about the similarities and the similar approaches to dealing with inflation and the positive results. But we've seen a divergence in Canada with respect to growth. So clearly there's some differences too. Maybe can you reflect for people what those differences look like and what the ramifications are for you?
Yeah, I will focus on the differences, although I will stress I think the main story is the similarities. And as Jay outlined, what is so unique about this whole cycle is that supply has played a much bigger role than we're used to. And from a monetary policy perspective, we don't have as good line of sight to supply as we do as demand, and we don't have any tools to influence supply. Our tools work on demand. In terms of what has been different, if you look at the Canadian economy, growth was essentially zero in the second half of last year. And what that meant was the economy, which was very overheated, supply caught up with demand. In fact, it more than caught up with demand. The economy moved into excess supply, and we're now seeing the effects of that in terms of relieving price pressure. So, why did demand slow more in Canada and the United States? I think that is a difficult question. I pointed to a couple of things in my opening remarks. I think productivity growth in the United States has been a lot stronger. You've gotten more supply than we have, so you've been able to grow more with less inflation or less inflationary pressure. And then the second thing is I think monetary policy is having more traction in Canada because the structure of our mortgage markets, half of mortgages have renewed in Canada. And even if your mortgage hasn't renewed, it's renewing in the next couple of years probably. So you're thinking ahead, thinking, when it renews, I'm going to have to be paying a lot more on my mortgage every month, so maybe I should be saving more money now. So we're seeing that effect. We've had weaker consumption growth. And certainly that's been somewhat masked by the fact we've had very rapid population growth. But if you look on a per capita basis, you can see household spending per capita, per family, has actually gone down, even though growth has not been negative overall. I think moving forward, we are actually seeing growth starting to pick up. The first quarter of this year looks pretty strong. We'll probably see some choppiness quarter to quarter, but overall we think that strength we're seeing in the first quarter will be sustained through the year, where we think on a quarterly basis growth is going to be averaging about 2% per quarter through this year. That's partly we're starting to see some pickup in consumption. Partly it is the resilience of the U.S. economy that is supporting our exports. They've been very resilient. And then coming back to inflation, I think those, broadly speaking, the path of inflation is pretty similar, but you are seeing, I think, some of those differences in the dynamics of the real economy in inflation. Our last few inflation readings have been reasonably good, even though totals still close to 3. Core has been, the last few times ticking down. And if you look at the more timely 3-month measures of core inflation, there is some downward momentum in underlying inflation. And I think that reflects the fact the economy is in excess supply, and that is relieving those price pressures. We're certainly looking for evidence that's going to be sustained. That's what we're looking for right now.
Well, I know that that both of you realize that one of the key things we were trying to emphasize today was the importance of the Canada-U.S. relationship, and I also really appreciate all of the comments on the importance of trade to both of our economies, trade between our two countries, and foreign direct investment. And so, while you're not trade policy experts, and I get that your organizations, that's not the focus, I really appreciate you giving us a little sense of, how do you think about trade in economic terms and the importance of that, and how that factors into your economic outlook. And specifically, we're thinking about the importance of the agreement between the United States, Canada, and Mexico, and wondering how you think about that in terms of its impacts on trade in general, on labor markets, on supply. So maybe I could ask you, Jay, to give us any reflections that you might have on that and deliberations impacts.
So I guess I need to start by saying we don't do trade policy. We don't really comment on trade policy other than to say that it's clear that we have a mutually beneficial, large, substantial, ongoing, healthy trade relationship with Canada that we very much welcome. Maybe I'll add one more thing, which is I want to focus on a particular export of Canada that I think somehow we just desperately need here in the United States, and we can't get enough of it. And that is Canadian comedians and comic actors. I started to count the number of really great, funny people, and I limited myself to 10. So Jim Carrey, Martin Short, John Candy, Mike Myers, Norm Macdonald, Rick Moranis, Dan Aykroyd, Catherine O'Hara, and Andrea Martin. And I could go on. So something's going on up there. Americans love Canadian. If that's Canadian humor, we absolutely love it. So send more. We can't get enough of it.
That's a small but important part of our trading relationship, I guess. Tiff, all jokes aside,
Yeah.
any comments from your perspective?
Yeah, well, first of all, as Jay underlined, we don't set trade policy, but let me just say, try to give you more of a picture. I mean, first of all, you just look at our two countries. The east-west border is the longest border in the world, and it's a long way across Canada. So it often makes a lot more sense to trade north-south than to trade across the country. And that's really, it comes down to geography in some sense. I mean, that's fundamental to the interties we have across our countries. Many Canadians are closer to fellow Americans than they are to fellow Canadians, just the nature of the geography. You look at what are the things that we buy and sell? Well, some of the biggest things. In Canada, we buy a lot of your consumer goods in the United States. We have a very two-way relationship on motor vehicles. You buy a lot of the motor vehicles we produce. We buy a lot of cars and trucks that you produce. Similarly, energy. We're both energy producers. It often makes more sense to trade the energy north-south than to ship it across the country. So we have a very dynamic two-way energy relationship. And you look forward and you think about how much electricity the world's going to need. I expect that relationship is only going to grow. Another element that is growing quickly, and maybe that's partly comedians, is the fastest growing part of trade is trade and services. Now, if you want a haircut, you still have to do it in your own country, unless you want to go to New York to get a really fancy one. But but increasingly, a lot of services are highly tradable. The internet has completely changed how many things are delivered, and so you're seeing Canadians are increasingly importing a lot of commercial services from the United States. And then the final thing I'll say is on USMCA. Obviously, for both countries, the market access is key. The other thing I would underline, though, it's also the certainty about the market access. The certainty that American companies have that they'll have access to Canadian markets and Canadians will have access to American markets. That allows businesses to make investments, to deploy their risk capital, to commit to the future. And it's that certainty of access that is really key to building investment. I'll stop there. Thank you.
Well, I'd like to thank both of you for taking some time with all of us. I think if we had looked back a couple of years ago and
let's see if Jay Powell says anything else. And keep in mind, I'll do a quick little summary
of our economies, we probably wouldn't have had an expectation that we would have been where we are today. We would have expected more challenges than we've faced. And I think we need to recognize that the stewardship that the Federal Reserve in the United States and the Bank of Canada in Canada have been responsible for has made an enormous difference in citizens' lives. I mean, we're in a situation that is virtually our best case scenario. So it's probably not often enough that on stage you're recognized for that important work, and I want to thank both of you for all that you're doing for all of us in making that the reality. And also I want to thank you for taking some time here. I mean, we are reflecting on the fact that in a couple of years, the U.S.-Mexico-Canadian trade agreement will be looked at again, and we want to reinforce the importance of working together, the importance of collaboration and cooperation, and really great trading relationships. So this is an important way for us to start this off, seeing the collegiality between the two of you, knowing how well people work together is really important for people. So thank you very much, and I know it's a busy week for you, so we appreciate also taking the time during this busy week. So thank you.
That was exceptionally boring. Okay, so we'll do a quick little summary here. Anything else?
Canada Institute, I'm going to ask Xavi Delgado to close off our session today.
Thank you, Bill. That concludes today.
Yeah, no, okay. All right, so look, I'd say it's slightly hawkish. That's the way I'm looking at it. This wasn't a big, this could have been way worse, but I say slightly hawkish is what I take away from this. You have Jay Powell talking about, he specifically used the word for the labor market, that the labor market is still very strong, and he specifically told us that we don't have to raise rates higher. It didn't, at no way did it seem like they had to raise rates. Instead, Jay Powell made it very clear, look, we could just keep rates higher for longer, have patience. I'll read this out a little bit, some of the things that I wrote down here. Recent data shows solid growth in labor and a lack of further progress on inflation. Labor market remains very strong, and that prior data that we got earlier this year did not give us more confidence on inflation. As such, we'll need more confidence. So that's why I say slightly hawkish. This was not by any means a dovish meeting where he's like, yeah, things are starting to crack in labor. This was definitely not dovish. And it was slightly hawkish because he finally told us the latest data has not given us greater confidence. And if this higher persists, we can maintain higher for as long as needed. Now, when the market first heard that, we had some heart palpitations in the market. The SPY plummeted for a moment there down to 502. It's back at 5045 now. So you had some stability that the market has sort of brought back right now. But this is slightly hawkish. I wouldn't say this is like earth-shattering or groundbreaking or anything really surprising. We would expect him to be a little hawkish. It'd be weird for him not to be. So I don't think this meeting was anything out of the ordinary, and there wasn't anything crazy, with the exception of really just making it clear that, yes, finally the Federal Reserve agrees we do not have more confidence yet on inflation, and there's still more work to be done. So that's Powell. We get Collins a little later today, but we had Johnson this morning, which was pretty boring. I don't know that we're really going to get any major Fed speak or catalysts now. The next Fed meeting is really after PCE comes in about 2 weeks. So we're probably a little bit quiet on Fed catalysts for a minute here. And it looks like markets are, rebounding on the fact that we didn't get like a larger rugging or anything weird here. So you've got, as you can see, let's pull it up really quickly here. Keep in mind, this Friday, we got an expiration of the coupon code for the programs on Building Your Wealth, link below. But what you could see here is you could see the Qs actually rising. I'm going to put them back on the averaged candlesticks here. There we go. Qs are rallying after this. This is the highest we've seen the Qs move after Jay Powell didn't give us a rugging. You've got actually quite a few stocks rallying right now. You've got Tesla that's moved from about 3.5% to the downside up. You've got the Qs up 0.5% after Jay Powell's finished over here. You've got Nvidia over 2% again. You've got Bitcoin sitting at about 62.8. That's nice. I've got about a 63 ceiling right here on BTC, but a lot of euphoria coming in, it seems like, right after Jay Powell is done speaking. You've got the SPY. The SPY was down as much as 20 basis points. It's actually up 25 basis points now. So big flip-flop here on the market after Jay's done. You've also got Apple back above its resistance down here that was bobbing around a little bit, that 169 level, probably more of a support level. We really haven't broken down below that 169 level on Apple. But yeah, this is really interesting. You're getting ARM all of a sudden up about 1%. You've got Amazon goes positive after that Jay Powell meeting. That Jay Powell meeting was, quite frankly, felt a whole lot more like a bromance, marriage counseling event than anything real on the economy, other than Jay Powell suggesting we don't have the confidence we need yet. But again, that seems to be mostly anticipated. Want to see how yields are moving right now. Yields right now sitting at about 1.65. We went as high as about 6.7 there, so we've kind of chillaxed again a little bit. So seems like you got excitement coming in and euphoria. So we'll see how this changes. Gold's still sitting at 2,400 though. We'll see how that changes any kind of trading. I'll send any kind of trade alerts in the Stocks Insight group. As usual, thank you so much for being here. I'll go ahead and hit the button here, but remember, if you've got questions on bundling up, email us at staff@meetkevin.com for bundling up, whether it's the event or other courses. We've got new lectures coming out this weekend. Make sure you post your suggestions there, and do make sure you watch BTC. BTC is really getting stuck at that 63 level. To me, that 63 level is a big deal, and it could be a sign that we're getting sort of a false little rally in the market right here. Let's see if the market supports this going into the close. But we'll pay attention to it. So let's keep looking at sticks for a moment while I push this button here. Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate an actively managed ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker. That 780 line is a big deal for NVIDIA, so I'm watching that one. Still not above 63 on BTC. Gives me some idea or some potential thought that this could just be sort of a little fake pump here or something after Jay Powell's done. Unless we got some news on Israel here, which I don't think we do. I'm pretty sure the latest on Israel is that we are expecting some form of ground attack, and we are waiting. So standing by on that, as well as obviously the funding bills for the Red Sea. So we're watching this. Looking at, yeah, BTC is right there, though, so who knows? We can push through it. And then, where's AMD? That's another one I want to watch. AMD. Here we go. Yeah, this is where AMD was topping out earlier. So I'm really going to watch, again, AMD, NVIDIA. Are they going to be able to pull through that 164.4 level? And then I'm watching NVIDIA. There we go. Another green candlestick there on AMD. Is this going to be the breakout that it needs? NVIDIA, look at the Qs keep trying to push 60 basis points on the Qs. There's the 880 on NVIDIA, and there's 63 on BTC. Now the question is, can we hold above it? So 880, big level there on NVIDIA. Yeah, but this is a good rebound after yesterday to the upside. And SPY's also moving a little higher, 31 bips here. Apple 142. Nice recovery, although will it last? Let's go to the single candles. Palantir, nice move up. Amazon. See, Amazon's already leading us right back down. So it makes you wonder, and so is Microsoft. Is that going to hold? Here come the red candlesticks right now. So anyway, there you go. Thanks so much for watching. We'll see you soon in the next one. Goodbye, good luck. I'll send trade alerts to course members in the Stocks Insight group. Bye.